Stop losing money. The 1% rule every trader must use. You are losing trade not because your strategy is bad, but because your risk management is trash. One rule, just 1%, separate professional traders from the 90% who blow their account. In this next minute, I will be showing you how this single one rule protects every dollar you trade with. If you have ever blown an account or taken loss that made you question trading, you are not alone in this. Every beginner does this, including me. I once did this until I learned this 1% rule. It's not a magic trick, it's math and discipline. Once you understand it, you will never look at risks the same way again. Welcome to my channel. I am Mr. Joshua that teach traders how to trade the smart way. And in this video, I'm going to be teaching you the 1% rule every trader must use. Now, the aim of trading is not to blow an account in one trade and then be handicapped in the next trade. The goal of trading is so that you can build wealth and build your capital. So you are only permitted to lose 1% of your capital. Now, the 1% rule means that you never risk more than 1% of your total capital on a single trade. If your account is $1,000, the maximum you can lose on any trade is $10, which is period. You cannot lose more than that. You cannot lose more than that. Here's the truth. Markets are unpredictable. You can have 5 losing trades in a row and still be safe if you use the 1% rule. But without it, just 2 bad trades can destroy your capital entirely. That's happened to me, and it's happening to many traders out there. And that is the reason why I'm doing this video. So, how do you apply it? The first step, decide your stop loss in pips or price difference. Decide your stop loss in pips or price difference. Now, multiply your total account by 1%. That is your maximum risk that you can take. When you multiply your total account by 1%, that would be your maximum risk. Then you divide that number by your stop loss distance to get your position size. You get your position size. Now, I'm going to teach you practically how you can do it. Now, for example, you're having, let's say, you're having a $5,000 account and your stop loss is 50 pips. Now, what will you do? What will be your maximum risk? Your maximum risk will be what? $50 because of the 1%. The 1% of $5,000 is $50. Now, the position size will be $50 divided by 50, which will be $1 per pip. So if you have 50 positions and in all these 50 positions you are able to lose $1 in it, then you should close the account. That is what it means, because you have what you have used the $50 at a roll. Now, that is how professionals trade without emotions, because the numbers are already decided. They don't just pick trade anyhow. They pick trade by analyzing it. Now, why most traders fail is not because their strategies suck, but because they use the risks of 5%, 10%, even 20% on one particular setup, which is very bad. One bad trade, boom, your account is gone because they refuse to use the 1% risk management. Now, they are confused and they are tired of what? Of losing. But you see, the confidence with recklessness is still equals to zero. When you are confident and you are reckless, it still equals to what? Zero. Now, let me give us an example that will help us, because I always intend to break down things for us so that we'll be able to understand it clearly. Let's say right now, you know, when we're talking about risk management, we're talking about discipline and strategy. We're talking about discipline and strategy. Discipline and strategy. Now, if you are um if you are serious about never blowing an account, you have to follow this carefully. This example that I'm giving, you have to follow it what? Carefully. Don't skip any part of this particular video. Now, let's say that you have a $1,000 account. You want to risk only 1% of your capital. Well, 1% is $10. 1% of $1,000 is $10. Now, what you will do is $10 divided by 30. $10 divided by 30, which is going to be 0.33 pips. So this is very simple. 0.33 pips, and that is also uh, $0.33. Now, this is it. Your stop loss is the 33, the 30, sorry, that you are dividing the loss with, so that when your loss reach the level of your stop loss, you are going to close the market. Hope you understand. It's as simple as that. You're having your stop loss of 30 pips, and then you're having you're actually looking at only risking 1% of your trade, which is $10, which means that you're going to do 10 divided by 30, and it's going to be 0.33. Now, if peradventure in one trade you lose such amount, you are permitted to close, because it is 1% loss that you are after. You don't want to lose more than that. Now, that is how simple it is for you to be able to calculate and to know how you should use only 1% of your trade in order for you to trade efficiently. Now, if this video has been helpful to you, and if you are serious of never blowing an account, hit the like button right now. Comment 1% rule, so I know that you are actually joining the disciplined traders. And if you want to understand position sizing, I'm going to do a video concerning that, and I will see you in the next video. The next video is going to be exciting. I'll be talking about the position sizing. Talking about position sizing, because your position sizing and also your risk management go hand in hand. You must know how many positions you should enter in a particular capital. When you have a particular capital, you should know the positions that you should be able to enter, so that it will help you not to blow your account. If you find this video interesting, kindly share this video with your family and friends, and also click the notification bell so that you'll be notified whenever I upload a video such as this. Don't forget to subscribe to this channel. See you in the next video, and I hope that this video make impact in your trading careers. Have a great day. I remember Mr. Joshua that help traders to trade the smart way.
Thank you for watching this video. Do like, share, comment and subscribe to this channel for more information.